Today we will be discussing on the chapters number 10 and 11. We'll be taking a few questions from the revision test papers, friends. Hope it's clear. Let's go forward. Question number 1. As you can easily understand, this question is based on related parties. Int AS 24 covered by chapter 10. Let's read the question, friends. Mr. X owns 95% of entity A and is its director. So it's very clear that Mr. X is capable of controlling entity A, not necessarily by holding the shares, but also by being its director. He's a key management person. He is also a beneficiary of a trust that owns 100% of entity B. So he's a beneficiary in a trust. The trust owns 100% shares of entity B, of which is a director. So what is the status of X here? X holds 95% shares of A, director of A, director of B, in which 100% is held by a trust of which X is the beneficiary. That is the position of A. Now, question is whether entities A and B are related parties. For answering questions like this, friends, you should be aware of the relevant provisions of Ind AS 24. A problem of this nature may appear in the exam. The questions on related parties are not very frequent in the exam, but can fetch you in the range of 4 to 6 marks. Now, there is first question depending on the situation given. But later they're asking you, would the situation be different if he has resigned as director of entity A, but retained his 95% holding? So he's no more a director, but he's holding 95% shares. B, he resigned as director of both A and B. He has also transferred the 95% holding in entity A to the trust. So he's still the beneficiary of the trust. The trust is holding 100% in B, but he's not a director of A or B. But the 95% holding that he was having in A is being transferred to the trust. So if these are the situations, maybe I can show the question once again. What could be the solution for this problem? In my opinion, a problem like this can carry anywhere between 4 and 6 marks, assuming on an average they give you 5 marks. Problems on related parties has to be answered in a specific manner, because here you find there is no calculation required, no numerical values. It's mere application of the relevant paragraphs of the accounting standard, relevant accounting standard. Friends, I've always been telling you, whenever you answer a question on any accounting standard, it is very essential that we determine, we identify the standard. And of course, whatever is relevant to this question, which is prescribed in the standard, we should write in our own words. Then we should discuss the contents of the question. Then we have to come to a conclusion. So 4 marks are given or 5 marks are given if you are able to present the answer in a manner in which a chartered accountant will approach a situation. Then you'll be getting full credit for your answer. So friends, I hope I've given you ample time to apply your mind on the situation. Most probably you would have got the answer. But anyway, let me also share with you the answer and how to present the answer. Determining the answer may be easy, friends, but the way in which you present the answer only will ensure that you get the full credit for your answers. If not full, at least for a 5-mark question, you get 4 marks. That is really worth it, is it not? So, friends, let us see how to present the answer. The question is basically whether A and B are related parties. Yes, there is no doubt. Why? Because Mr. X controls A and also B. How X controls A? By holding 95% shares in A. And in case of B, he is a part of the key management personnel. Therefore, A is controlling, Mr. X is controlling A as well as B. So, no doubt that entities A and B are related parties. That is the first answer. But of course, I would have preferred to present the answer different manner. Like you should first write this situation or the problem is based on in days 24 and also write a few sentences about when would you say parties are related, at least from the point of view of the question. You could write some theory and then you could come to a conclusion. But because it is very evident, obvious, and clear, I think the answer is presented straight away that entity A and B are related to each other. But we have to answer the other questions. A has resigned as director of entity A and so on and so forth. What would be the situation? Whether A and B will still be related or not, that is the most important question, friends. So let us focus on that. X resigned as director but retained his 95% holding. Now, only one thing. X is not the director of A, but all other situations, all other positions are clear. A is holding 95% shares in A. X is holding 95% shares in A. X is a director of B. A trust holds 100% shares in B. X is a trustee, is a beneficiary of the trust. So, has it changed the relationship in any manner? So, you can see that even after resigning from the directorship of entity A, X controls that company because he's holding 90% shares in that company. He may not be a director. Director is part of a key management personnel, but not necessarily. But by controlling the company A and by being a director of B, he is a key management personnel of B. Mr. X is controlling A as well as B. Therefore, entities A and B are related. In addition to that, the trust is having 100% shares in B, of which A is the beneficiary. So therefore, through the trust also, A is controlling B. So when both the entities A and B are controlled by the same person, namely Mr. X, there is no doubt that A Limited and B Limited are related parties. Hope this is clear, friends. Answer for subdivision A. Shall we go forward and take up the next question? Who is a key management personnel? All that we are telling you. Whether X is a key management personnel, yeah, he may still be a key management personnel of entity A. See, whether he is a director or not, it doesn't mean that he should be a key management personnel only if he's a director. That's what I told you. A key management personnel includes a director. Could be an executive director, otherwise, not a problem. But if Mr. X has the authority and responsibility for planning, directing, and controlling activities of entity, still X could be the key management personnel of A. Therefore, from all accounts and from different angles, you can say X is controlling A as well as B. Therefore, A and B are related. Now the second situation. X has resigned as director of A as well as B and is transferred 90% holding in entity A to the trust. Now, what is X's position now? X does not hold any shares in A. X is not a director of A. X is not a director of B. But the trust of which EB is the beneficiary holds 100% shares in B Limited and 95% shares in A Limited. Understand the situation, the relationship. There are two companies, A and B. The trust is holding 90% shares in A, 100% shares in B. So the trust is controlling A as well as B. And who is the beneficiary of the trust? Mr. X. That is the situation. Now, if that is a situation, whether A and B are related, that's the question. So, if Mr. X controls the trust, see, I'm using the word if. Just because X is the beneficiary of trust, you cannot conclude that X is controlling the trust. But if X is controlling the trust and the trust is controlling A and B, what is happening? Mr. X is controlling A and B through the trust. So they will be related parties as above. Mr. X is a key management personnel of the entities. He continues to direct their operating and financial policies. So what we should see is the substance, not the legal form. Legally, he may not be controlling, he may not be exercising significant influence. But what is the substance of relationship should be actually seen. So therefore, if Mr. A can control the trust or can exercise significant influence over the trust, in turn, the trust is controlling A and B. Therefore, you can say any transaction that happens between A and B has to be reported because A and B are related to each other. So this is the way by which, friends, you might be required to present the answer. Of course, the words can be different. The manner in which you present it can be different. The order in which you can present it different. But certain terms like substance or form, substance of relationship, not the legal form, should be considered. If you're able to, note these words and present it in the answer, definitely you'll get, if not full, at least 4 out of 5 or 3 out of 4 for this problem. So friends, I think I have explained the solution to the best of my ability, and of course, in a manner in which they will be able to understand it clearly. So, before I start with the next question and the solution, therefore, as usual, I am giving you some time to apply your mind on the solution to question number 1. And if you have any questions, please feel free to ask me. Let me explain that. I'm waiting for your questions, if any. If there are no questions and you are clear, at least you tell me, sir, we are clear, we can go forward. I will go forward. Because as you know, friends, I am visible to you, you are not visible to me, though it is not mandatory. But how would I know that you are clear? So please interact. Either you unmute and speak to me, or you can put it in the chat that you are clear. So that will help me to go forward. Yes, Santosh, Meera, Thampi, and Smruti, Karthikeyan, everybody believes. Hemant, okay. Most of you are clear that you have understood this. Hence, That allows me to go forward, friends. Thank you so much for that. Let's go forward. Question number 2. You are provided information pertaining to an entity for the year ending 31st March 2021 or 2011, as the case may be. As you can see, this problem is based on earnings per share in AS 33. They are given you net profit for the year. Wayne's weighted average number of equity shares outstanding is 5 lakh. Average market price per share is 20. Wayne's under option is 1 lakh share. Exercise price per share under option is 15. So initially 5 lakh shares are there, or during the year weight average is 5 lakh shares. But during this year, the company has granted an option of 1 lakh shares, which can be exercised at the rate of 15, whereas the market price is 20. Normally, this is what happens when an option is given, is it? The option price will be at a price lower than the market price. Now, what could be the requirement for this question? Calculate basic and diluted earnings per share. That's it. Friends, I know it's a very simple question. Many times you have done problems like this at the intermediate level itself. But you may say that, sir, that was accounting standard 20. This is Ind AS 33. Let me tell you clearly, friends. There are no significant difference between accounting standard 20 and Ind AS 33. Even if you remember AS 20 clearly, then you can easily solve problems on Ind AS 33. Of course, AS 20, we may not have learned it fully at the intermediate level. Whereas when you come to the final level, we are supposed to learn calculation of EPS from the consolidated financial statements also. That is what is prescribed in Ind AS 33. But this problem is not based on that. It's a very simple problem. Where an option is available, calculate the basic and diluted earnings per share. The basic earning, easily we can tell you, isn't it? You can tell me 12 lakh is the profit, 5 lakh is the number of share. So 12 lakh by 5 lakh will get to the basic earnings. Diluted earnings. Friends, I know you might have learned it, but still I would like to tell you what is the meaning of diluted earnings. Earnings gets diluted. Simple. Suppose the basic earning was 5 rupees. Because of the presence of some potential equity shares, in future, the number of shares will increase, but the earning will not increase, will not at all increase, or will not increase in the same proportion, such that the quotient will be less than the basic earnings per share. In such situations, there is a possibility that your earnings per share may get reduced, may get diluted. What are those possibilities? Even though this problem is based on options, I would like to tell you what are the various possibilities when your earnings per share may get diluted when a company has issued convertible debentures or preference shares. And the option to convert it is available to shareholders at any time or maybe after a certain point of time. Now, in the place of convertible debentures, had they issued normal debenture, then there is no right available to the debenture holders to convert that into equity shares. So number of shares is not going to increase on account of that. But when a company has issued a convertible preference share and the option is available to them to convert it, there is a possibility the number of shares will increase. That is, the denominator will increase. Whether the numerator will also increase in the same proportion? The answer is no. Because friends, as you know, if debentures are converted into shares, then the requirement to pay interest does not arise. So to that extent, the profit will increase. But as you know, when the profit increases, tax also will increase. So the net benefit will be what? After tax benefit is what you have to consider. Suppose if the tax rate is 30%, which is normal for a corporate, if interest is 1 lakh, which you need not pay after conversion into equity shares, consider only 70% of the benefit. Because 1 lakh you need not pay, but you have to pay 30,000 rupees more as tax. So the benefit accruing to the shareholders will be 70,000 monthly. That should be added back to the profit to get the adjusted profit. That will be the numerator. Denominator will be the shares already issued plus potential equity shares. It's not that the debentures have been converted into shares. It is probable it may be converted into shares. So if those shares are converted, the profit will get adjusted in this manner. The number of shares will increase. And most probably, the increase in denominator will be more proportionate than the increase in the numerator. I'm not saying it is always, but there is a probability like that, more probability like that. So therefore, what will happen? When you compare to the basic earnings per share, your earnings per share may get reduced. So we call it as diluted EPS. But you can ask me, sir, will it always happen? Not necessary, friends. Sometimes, based on the potential equity share, there is a possibility the earnings per share may increase also. Then we call that situation as anti-dilutive. So, the presence of a convertible instrument will ordinarily result in dilution of EPS, but it is not mandatory. Sometimes earnings per share may increase also. Then you say there is no dilution of earnings per share. It is anti-dilute. Similarly, when options are being given, granted by a company, definitely there will be a dilution. The reason is when options are given, it will always be at a price less than the market price. That means, see, in this problem, 1 lakh shares are issued. No. Had they issued in the market, they would have got 20 lakh rupees. But they decided to issue to the employees or others at 15 rupees. That means they are losing 5 lakhs. No. If these 1 lakh shares are issued at the market price, the company will get 20. That means they get more capital. More capital will result in more profits. That's what we believe. But by giving the option, the company is sacrificing 5 lakh. They're getting only 15 lakh rupees. They're sacrificing 5 lakh. So to that extent, their profit gets compromised, is it not? So there is a possibility the numerator, that is the earnings per share, may not increase in the same proportion as the denominator, that is increase in number of shares subsequent to exercise of options. So there is definitely a possibility of a dilution of earnings per share when there are options, when there are convertible debentures, when there are convertible preference share. We call it as potential equity shares, which has a potential to dilute the earnings per share. So this is one such situation where there is a possibility of dilution of earnings per share. We are asked to determine what is the diluted earnings per share. How to do that? The actual calculation is not at all difficult. I know very well that you people have already done problems like this. But I thought this as a good opportunity to explain the concept of dilution of earnings per share so that the answer to this is available to you. But for others, for example, a convertible preference share is there. Then also what will happen? As long as a share is preference share, the payment of dividend is mandatory. But once it becomes equity, there is no compulsion to pay dividend. So to that extent, the profit available to equity shareholders will increase. And the number of shares also would increase, which may result in dilution. So like that, a situation is given to you where a company has granted options at the rate of 15. 1 lakh shares, whether there is a dilution or not. But one thing, let me tell you clearly, friends. Normally, dilution will be there. Even otherwise, you can read the problem carefully. It says calculate basic and diluted earnings per share. That is an indication that there is a possibility of dilution. But I'm not confirming that. Let us calculate after considering the potential equity shares, see whether earnings per share is reduced. If so, then we would say there's a dilution, and that will be the diluted earnings per share. So, friends, there is no big fun in calculating basic EPS, PEPS, 12 lakh by 5 lakh, 2.4. Clear? I should not ask even this question at the final level. What about diluted earnings per share? When dilution will happen, friends, I told you, when a company happens to issue some shares without getting a consideration. Because if they get a consideration, that will be invested in the business, which will result in profit, increase in profit. But out of the 1 lakh share under option, certain shares are going to be issued without getting any consideration. So simple increase in number of shares with no corresponding increase in the profit available to equity shareholders. Even though 1 lakh shares under option, how many shares are going to be issued without any consideration? Like, you have to divide that shares under option in two components. One for which you get a consideration, one for which there is a bonus element. You don't get a consideration. How to calculate that? Shares issued without consideration is equal to shares under option minus shares issued at market price. For example, in this problem, 1 lakh shares are given. Exercise price is 15 lakhs. So the company will receive 15 lakhs only. But had they issued the shares in the market, they would have got 20 lakhs. That means the company is issuing the shares by sacrificing 5 lakh. So that is a bonus element. If 5 lakh rupees is the bonus element accruing to the option holders, what is the sacrifice by the company in terms of number of shares? If you're able to calculate that, you'll get it as 25,000. How 25,000, sir? Market price is 20, whereas issue price is 15. So, if you consider 15 by 20 of the number of shares under option, you will get the number of shares which we should have issued at market price. That is 75,000 shares. In other words, friends, to get the same consideration of 15 lakhs at market price, how many shares the company should have issued? 1 lakh into 15 is what they get, 15 lakh. But suppose if the shares issued in the market, they have issued at 20 rupees, is it not? So to get the same 15 lakhs from the market, they would have issued only 75,000 shares. That means out of 1 lakh share under option, you are getting a consideration as if you got it towards 75,000 shares only. Therefore, the remaining 25,000 shares are issued as if the company has not got any consideration. Therefore, increase in number of shares without consideration is 25. 1 lakh minus 75, 25. Already 5 lakh shares have been issued, but there will not be any change in the earnings available to shareholder because you're issuing shares free of cost, no inflow of capital, no increase in profit. So profit is 12 lakh only. So divide the 12 lakh by 5 lakh 25,000. You find the earnings per share now is 2.29, which is less than 2.4. Therefore, we conclude there is a dilution in earnings per share Hence, the diluted EPS is 2.29. I'm sure, friends, your understanding would have been a little bit more better than what you had learned earlier. But suppose if you got more confused, please excuse me for that. I thought I'm giving you more clarity. And I believe you got better clarity also. So the note tells you earnings have not increased because only total number of shares have increased. Such 25,000 shares are deemed to have been issued for no consideration at all. Therefore, in the denominator, the number of shares to be added is only 25,000. Numerator remains constant. So denominator increases, numerator no change. Definitely cash quotient will be less, resulting in dilution. Therefore, the diluted earnings per share is 2.29. How much marks you can expect for this question? They give you more than 4, you should be happy. They give you less than 4, you should still do it because it's not difficult. But at least you get 2 marks or 3 marks. You should be happy about that. But definitely, you can easily finish this off in maximum 5 minutes. Let it be 5 marks or 3 marks. You cannot take more than 5 minutes for this problem. So assuming all of you are 100% clear about this explanation and the solution, I am straight away going to the third question, friends. Third question is based on deferred taxation. It's definitely a very, very important standard. Not necessarily from exam point of view, friends, but from practical point of view. When you finalize any financial statement, either as a accountant or as a member of the board or as a chartered accountant, whatever be your position, you cannot avoid this standard, is it not? Standard on deferred taxation. So there may not be a situation of related parties. There may not be a dilution of EPS. But can anyone say there may not be a situation of deferred taxation? Absolutely impossible, particularly with reference to listed companies. It's not at all possible. So therefore, we thought we will take up a very good, difficult problem on deferred taxation, and then we will discuss the solution. So friends, as you can see, the question entities finalizing its financial statement for the year ending 31st March. Before 31st March, understand carefully, friends, before 31st March. This is a very, very important point. Before 31st March, the government announced that the rate to be amended from 40 to 45 from June 2002. Okay. The rate will be amended from June 2002, but the decision to amend it has been announced. Proposal was given before the end of the financial year. The legislation to amend the tax rate has not yet been approved by legislature. But see, there's a very important point. The government has a significant majority. So what is your conclusion? Or what is implied in the question? If the government has a significant majority, you can easily understand all their proposals in the parliament will be approved. Because it's after all a simple majority you need. But the question says the present government, according to the question, has a significant majority. And whenever they're going to bring about any bill, it is going to be passed in the parliament. So it is usual in the tax jurisdiction concerned to regard an announcement of change in tax rate as having the substantive effect of actual enactment. That means what? It is substantively enacted before 31st March itself. 100% certain that the change in rates is going to happen. So this is a very, very important term given in the problem. If you read this, understand this carefully, you will surely get the answer right. After performing the income tax calculation at 40%, the entity has the following deferred tax asset and liability balance. So even though there is a proposal to increase the rate from 40 to 45, the company has finalized the accounts based on 40% tax rate and have determined the deferred tax asset at 80,000, liability at 60,000. Remember, this is the deferred tax asset and liability. So this is not the actual difference. The difference will be what? If 80,000 is a deferred tax asset, it is equal to 40% of the difference. So we have to calculate that. What is a temporary difference or deductible temporary difference? Like that, we have to calculate. Okay. Of the deferred tax asset balance, that is out of this 80,000, 28,000 relates to a temporary difference. See, there is a deferred tax, is temporary difference only. There is absolutely no doubt. This deferred tax asset had been previously recognized in OCI. Okay, that is more important. Normally, a deferred tax asset is recognized in P&L as a credit. But sometimes a deferred tax may arise on account of a change in value of a property, plant, and equipment. That's what could have happened. So out of 80,000 rupees, 28,000 pertains to a revaluation surplus. So if there is a revaluation surplus already accounted and accumulated in equity, the deferred tax arising on account of that would also be recognized in OCI, not in P&L. According to Ind AS 16, you should remember this. Or Ind AS 12 also tells you about this clearly. Okay. The entity reviewed the carrying amount of the asset in accordance with paragraph 56 of Ind AS 12. Determine the probable that sufficient taxable profit allow utilization of deferred tax will be available in the future. See, whenever you recognize a deferred tax asset, there should be a virtual certainty that in future sufficient profits would be available to adjust it. Then only a deferred tax asset should be recognized based on the principle of prudence. See, recognizing a deferred tax liability you can do, no problem. If there's an iota of doubt, recognize deferred tax liability. But on the contrary, you just cannot simply recognize a deferred tax asset because a deductible difference will result in a deferred tax asset, is it not? Sorry, a taxable difference will result in a deferred tax asset. So only when there is a probability of a future profit against which the deferred tax can be adjusted, you can recognize a deferred tax asset. The problem tells you that in future sufficient taxable profit will be available so that the deferred tax asset can be adjusted. Show the revised amount of deferred tax asset and deferred tax liability and also present the necessary journal entry. Why revision? The financial statements have been finalized based on 40% tax rate, but the rates have been proposed to be revised to 45. The announcement for that came before 31st March. It is 100% certain that the rates will be changed. So therefore, since deferred tax relates to future, it's essential that the deferred tax shall be determined or measured based on the future tax that is substantively enacted. So in the place of 40%, we should now calculate 45%, and the difference arising on account of that shall be further recognized in the financial statement. So that is why they're asking you the revised amount of deferred tax asset and liability. And of course, you are asked to make the necessary journal entries also. Now, where there is a deferred tax asset, there should be a deductible temporary difference. So 80,000 is the deferred tax asset. For 40% existing rate, what is the deductible temporary difference? Divide, you'll get. So actually, there was a deductible temporary difference of 2 lakh. They applied 40% of that. They got a deferred tax asset. So deductible temporary difference leads to deferred tax asset. Had I said anything differently, I stand corrected, friends. If there is a deductible temporary difference, it results in a deferred tax asset. If the deferred tax asset is 80,000 and the rate is 40, the deductible temporary difference would have been 2 lakhs. Similarly, there is a deferred tax liability of 60,000. A taxable temporary difference will result in a deferred tax liability. So deductible temporary difference results in deferred tax asset. Taxable temporary difference results in deferred tax liability. If the liability was 60,000, rate is 40%, the difference would have been lakh and 50,000. So the deductible temporary difference was 2 lakh. Taxable temporary difference was 1 lakh 50, giving rise to a deferred tax asset of 80,000 and a deferred tax liability of 60,000 measured at the rate of 40% only. That is how they have recognized it in the financial statements. But you know, friends, the rate is going to be 45% from now onwards. But out of the total deferred tax asset balance of 80,000, 28,000 is on account of a revaluation surplus recognized in OCI. So therefore, out of this 80,000, how much would have been recognized in P&L? 52,000 only. Total deferred tax asset is 80. Credit to P&L is only 52. Credit to OCI is 28. So deferred tax asset account debit 80,000. That was the original entry. Deferred tax asset account debit 80,000. To P&L 52. To OCI 28. That was the original entry. So if the deferred tax asset of 28,000 is on account of OCI, what would have been the difference? Difference is 70,000 rupees. So out of the total 2 lakh of deductible temporary difference, 1 lakh 30 recognized in P&L, 70,000 recognized in OCA. Okay. Because when you revise the rates, you have to recognize it appropriately to the extent in P&L and the balance in OCA. That's why we are segregating that into two components. Now, under the new rate, what will be the deferred tax asset and the deferred tax liability? Apply 45%. Previously, you have credited 28,000 to OCI, but now it will be 31,500. Apply 45%. Previously, you recognized only 52, but now it will be 58,500. So by applying the new rates, the deferred tax asset will be 90,000. That means there is increase of 10,000 rupees of deferred tax asset, of which 3,500 should be increased credited to OCI, 6,500 should be increased credited to PN. I'll be showing the comparative statement later. Deferred tax liability was 60, but it should be 67,500. So what has happened now? By changing the rates of tax, there is an increase of 10,000 in deferred tax asset, an increase of 7,500 in deferred tax liability. So the net increase is 2,500 rupees. That's what we have to understand, friends. I'm sure you're all following, and there is complete clarity on what we are discussing, friends. Feel free to interrupt anytime, ask any question. I am, as usual, ready for any questions, friends. So that's what I told you, friends. What is the net adjustment? 2,500, correct? No? It is a reduction of the deferred tax expense. Total 10,000 increase in deferred tax asset. Deferred tax liability increase is 7,500. So deferred tax asset has increased by 2,500 net amount, resulting in a reduction in the deferred tax amount of 2,500, of which you have to recognize 3,500 in OCI and 1,000 in P&L. Total reduction is 2,500, but how much should be recognized in OCI? 3,500 net amount. 1,000 will be charged to P&L. That means you will further credit OCI by 3,500, but you will be debiting P&L by 1,000. So net effect of 2,500 will be considered in OCI. That is the understanding. Okay. Now, I think this statement will give you a better idea of what we are discussing. So the original deferred taxation transfer to OCI is 28, but it should be 13,500. That means you have to credit OCI by 3,500. Further credit. Previously recognized 52 based on old rate, but it should be 58,500. So you have to credit P&L by 6,500. So the total credit to P&L will be 10,000 by debiting deferred tax expense, which will be taken to deferred tax asset. Similarly, old deferred tax liability 60, new 6,500. So net effect is, increase in deferred tax liability is 7,500. So net adjustment is 2,500. So you have to recognize a further deferred tax asset of 2,500. That's all, friends. Now, what are the journal entries you have to make? One by one. Of course, this is another method. What we did was 40, we calculated 45, then difference. We can calculate like this also. What is wrong? Is it not? 5% of 70,000. You have to show it in OCI now. 5% of 1,30,000 we have to show in P&L now. That's all. So this way also we can calculate. Only an alternative method. Now, journal entry. Increase in deferred tax asset to be credited to OCI. Debit deferred tax asset, credit OCI. Increase in deferred tax asset to be credited to P&L. So I'm crediting to deferred tax expense. Ultimately, that will be credited to P&L. Decrease of deferred tax expense. Then increase of deferred tax expense is 7,500 because of increase in deferred tax liability. So increase in deferred tax asset to be credited to OCI is 3,500. Increase in deferred tax asset to be credited to P&L is 6,500. Increase in deferred tax asset to be debited to P&L is 7,500. So you can see net amount debited to P&L is how much? Sorry, credited to P&L is credited to OCI 3,500. Debited to P&L will be 1,000. Correct? No, we are crediting 6,500 to deferred tax expense. We are debiting 6,500 deferred tax expense. So net amount will be 1,000 rupees, which will be taken to P&L. So what are the journal entries we have to make? Increase of deferred tax asset by 10,000, debit. Increase of deferred tax expense, 1,000 rupees, debit. Increase in OCI on account of increase in deferred tax asset, credit 3,500. Increase in deferred tax liability 7,500. So instead of making so many entries like what we did in the earlier slide, we can put a combined entry also. So whichever way you want, you do, friends. There is no condition you have to make this entry in this manner only. This is for better understanding. I always prefer to make individual entries so that it's clear, number one, to me, and number two, to whom I am presenting it. So that's why we thought we will give you both ways. Simple journal entry for each. I'm giving you a journal entry. We are also presenting to you the combined journal entry. So increase in deferred tax asset, old 80, new 90, debit deferred tax asset. Of which 3.5 should be credited to revaluation surplus, that is OCI. Increase in deferred tax asset, 7.5 should be credited. The difference is to be taken to P&L. You record it as deferred tax expense. Ultimately, it will be taken to P&L. So, friend, this is very, very interesting and an important problem. Combining two standards, not one. Is it not? Ind AS 12 application is there. Ind AS 16 is also there. So two standards are applied in this problem. Problems like this are very much the favorite of the examiners or the paper setters, where there is a possibility of application of more than one standard. It attracts the paper setter. They will ask these kind of questions. The marks for this question can be minimum 6, maximum 8. So even had you taken around 10-15 minutes to solve the problem, that would have been worthwhile in the examination. So friends, hope we are clear about the way in which we presented the solution to you. As usual, I'm waiting for your questions, if any. If not, please tell me that you're clear, you do not have any doubts, so that I can take up the next question. Yes, friends. Question number 4. On 1st April 2001, Makers Limited raised a long-term loan from foreign investors. Investors subscribed for 6 million foreign currency loan notes at par. So wherever you find FCI, it will be foreign currency. It incurred an incremental issue cost of FCI 2 lakh. Interest of 6 lakh is payable on 31st March starting from the next year, that is end of this year. The loan is repayable in FCA on 31st March 2017. That means around 6 years later, they have to repay that. The effective implicit rate, very important one. In every problem where you come across a financial liability, whether it is denominated in foreign currency or otherwise, you will come across this point, implicit effective interest rate. So please note this point carefully. The appropriate measurement basis for this loan is amortized cost. A little bit of knowledge on Ind AS 109 is also required, because this being a financial liability, how do you recognize and measure it? A financial liability should have to be measured based on Ind AS 109 and presented as such. According to that standard, a financial liability can be recognized either based on amortized cost or based on fair value through P&L, FVTPL. The choice is available to the management, but normally management follows amortized cost. What is amortized cost? Initially, the loan is to be recognized based on the fair value by discounting the future cash flows at the effective interest rate. Subsequently, the effective interest rate will be added to the amount of liability. You'll be deducting the cash flows. You'll be paying interest, right? You'll be deducting that. You'll be getting the carrying amount of the loan at the end of every year. That is how accounting is prescribed under Ind AS 109 as regards a financial liability. So this company has adopted the approach of amortized cost for measurement of this loan. So a knowledge in Ind AS 109 is very much essential in order to solve this problem, coupled with Ind AS 21 as regards changes in forex rates. So this is again a problem, combining two standards. But primarily the standard is based on Ind AS 21 only. So relevant exchange rates are given. Opening rate is 2.5, closing rate is 2.75, average rate is 2.42. So when you measure a financial liability in foreign currency, we should always apply the closing rate. So at the beginning of the year, they would have recognized at that rate. End of the year, they'll apply the closing rate. Then why average rate is given, friends? There could be a reason for that. The functional currency of the group is Indian rupees. Very important. Functional currency. That means you're going to convert that in terms of Indian rupees. At that point of time, the interest transferred to P&L in foreign currency will be converted at the average rate because an expenditure is a nominal item. So there is a possibility of a difference in that. So that's the reason why the average rate is given. What would be the appropriate accounting treatment for the foreign currency loan in the books of Makers Limited for the year 11-12, first year? That's all. Calculate initial measurement amount for the loan, finance cost for the year, closing balance, exchange gain or loss. So various things you have to calculate. How the loan will be measured initially, how you will recognize the finance cost, what is the closing balance for the first year. Because it is denominated in foreign currency, there is a probability of an exchange gain or loss. All that we are supposed to calculate. Luckily, they haven't asked you the journal entries. So do not commit on that. Just calculate. That is sufficient. This problem can fetch you 6 marks in the examination. But if the examiner is very lenient, they may give you 8 marks also. But 6 is, in my opinion, very, very appropriate for this problem. So this standard is based on Ind AS 21. For measurement of the loan, initially we should apply Ind AS 109. Is it not, friends? For conversion, we should apply Ind AS 21. So keep that in mind. We'll be able to present the answer. Now, what is the initial carrying amount of loan in the books of accounts? The problem says we should take amortized cost. Having received a loan of 60 lakh foreign currency, if any cost are incurred at the time of issue, that shall be adjusted. Only balance amount can be recognized as a foreign currency loan. Not only foreign currency, any loan. If any cost is incurred, it has to be adjusted against the issue proceeds of the loan. Therefore, in the books of accounts, the loan will be recognized at 58 lakhs in foreign currency. But since the functional currency of the group is Indian rupees, we have to convert it in terms of Indian rupees by applying the opening rate because the loan is taken on 1st April. So according to Ind AS 21, the foreign currency transactions are initially recorded at the rate of exchange when the transaction was first recognized. So the transaction is recorded on 1st April. Therefore, what will be the initial recognition of the loan in Indian currency? At the opening rate. So 58 lakhs of foreign currency multiplied by 2.5. So initially, it will be measured at 1 crore 45 lakhs or 145 lakhs. Now, we have to calculate the amortized cost of the loan at the year end. How to get the amortized cost? 58 lakhs is the opening balance. That is the value at which the opening financial liability is recognized. Determine interest based on the effective interest rate, that is 12% on the opening balance, which is 6,96,000. If you want, you can calculate and see 58 and 12% comes to 6,96,000, whereas the actual interest will be 6 lakhs. That is 10% of 60 lakhs, 6 lakhs. So what will be the closing balance? Very simple. Opening balance plus effective interest minus interest, 58.96 lakhs. So at the end of the year, the loan in foreign currency will be 58 lakh 96,000. Initial 58 lakh, we have converted that at the rate of 2.5. End of the year, the closing balance of that liability is 58.96. We will convert it at what rate? Closing rate. And what is the finance cost in the books of accounts? It is 6,96,000 foreign currency. How you will recognize it? How will you measure that or convert that in terms of Indian rupee? Finance cost being an expenditure is a nominal item. We have to convert it based on average rate, which is 2.42. I think that is a rate, 6,96,000 into 2.42. Yeah, the average rate given in the problem is 2.42. So in Indian rupees, the finance cost will be 16 lakhs 84,320, which is nothing but 6,96,000 foreign currency multiplied by the average rate of 2.42. Whereas the actual payment of interest will be at 2.75. Why? The interest accrues at the end of the year, right? Interest becomes payable end of the year. So it's a liability at the end of the year. So the interest that would have been paid is measured at 2.75. So in the P&L, the finance cost debited will be measured by converting an average rate. But the actual interest paid would have been 16.5 lakhs only. So there is a difference in this, is it not? And there is a difference between the opening and the closing balance of loan measured in Indian rupees, is it not? Using that, you have to find out the exchange gain or loss. But any exchange gain or loss arising on account of conversion of a foreign currency liability or any transaction shall be taken to P&L. So we have to translate the loan closing balance at the closing rate. So what is the loan closing rate? 58 lakh 96,000 foreign currency is the closing balance of the loan. On that date, the rate is 2.75. So in Indian rupees, the closing balance of loan is 1 crore 62 lakh and 14,000. So we have determined the opening balance of the loan at which it is recognized. We have determined the finance cost. We have determined the closing balance of the loan, all in Indian rupees. And as I told you, there is any difference, we have to take it to P&L. So how much should be taken to P&L? As you know, friends, very well, opening balance plus interest at effective rate minus actual interest paid should be equal to closing balance. But there is a difference in between. Such differences the exchange difference. So 145 is the opening balance. Add 1684 320 minus 16.5. The closing balance should be, just a minute, 1 crore 45 lakhs. Yeah, plus 1684 320 minus 16 lakh 50,000. So the closing balance should be 145 34 320, whereas it is 162 14. So compare that. There is an increase in the liability, is it not? So minus 162 14, you will get there is a difference of 16 lakh 79,680 increase in liability. It's an exchange loss. Or if you do not want to commit on that, you simply say it's an exchange difference. This exchange difference should be taken to P&L. So friends, let me just summarize the answer. Opening balance of the loan will be issue proceeds minus issue cost, 60 minus 258 lakhs in foreign currency. In terms of foreign currency, find the effective interest 6,96,000 foreign currency. Actual interest is 6 lakh. So closing balance in FCI will be 5896. Now you convert everything in terms of Indian rupees. Opening balance, opening rate, 58 lakhs into 2.5 is 1 crore 45 lakhs. Effective interest, apply the average rate of 2.4 to 1684 320. Actual interest, apply the closing rate, that is 6 lakh into 2.75 16 lakh 50. Closing balance of loan in Indian rupees will be at closing rate 1596 into 2.75 is 162 lakh 14,000. Now compare opening and closing balance after adjusting for the effective interest and actual interest. There is a difference of 16 lakh 79,680 increase in liability. So that is nothing but an exchange loss, debit exchange loss, credit liability. The difference of exchange loss will be taken to profit and loss account. That is how the accounting should be done for this. Hope the solution was clear and the explanation was appropriate for you to be clear. Any queries are there, friends? Please tell me. Otherwise, allow me to go to the next problem. I have taken around 15 minutes to explain this solution, but definitely in the exam you can, if you have knowledge in India's 109 as well as India's 21, you can easily finish this problem in 10 minutes, which will fetch you around 6 marks in the examination. Yes, I think it's time for us to go to the next problem. Next problem, friends, it is based on operating segments. India is 108. Now, problems based on this will most probably ask you, which are the operating segments that are reportable? First of all, you should identify whether a business unit or a division as an operating segment. For that, you have to conclude who is a CODM, that is a decision maker. Based on that, you have to identify that yes, that particular division or the unit is an operating segment, number one. That is the first step. The second step is, out of the operating segments, how many are reportable? See friends, not all segments may be operating segments. Not all operating segments may be reportable segments. So when you come across a problem like this, you have to first decide or identify which are the operating segments. Then you have to find out among the operating segments which are reportable. For that, we have three criteria: revenue criteria, asset criteria, result criteria. And the threshold is very simple. If the revenue of a particular operating segment is at least 10% of the total revenue, if the assets of that segment is minimum 10% of the total assets, if the result of that segment is minimum 10% of the total results, that operating segment becomes a reportable segment. If an operating segment satisfies any of these three, not cumulative, alternative, either it satisfies result criteria or revenue or asset, it becomes a reportable segment. So in this problem, they are given you, there are 5 operating segments. That means the company has already identified the segments A, B, C, D as operating segments. So you need not check whether A, B, C, D are operating segments. So the question will be now, among these operating segments, how many are reportable? In this problem, they are given you the profit or loss. So we will have to apply the result criteria to identify which of these segments is a reportable segment. So segment A, B, C, D, E, profit or loss, loss given in parentheses. So the total profit of the company is 1,480 crores. C and D are loss-making segments. A, B, and E are profit-making segments. Now, what is the question? Based on the quantitative thresholds of which of the above segment A and A to E will be regarded as reportable segments for the year ending 31st March 2021. So A, B, C, D, E all are reportable segments. Out of this A, B, C, D, E, which are reportable based on the data given in the problem, which is the profit or loss made by that entity. Now, friends, how to determine which of the segments satisfy the threshold of 10%? See, if all the segments are making profit, very simple, find the total of that. That will be the denominator. In the numerator, you record the profit of that segment. If the quotient is minimum 10% or beyond that, that becomes a reportable segment. If all segments are making loss, so the company made a total loss, then denominator will be total loss of all segment, numerator will be loss of that segment. If the quotient is 10% or more, that becomes a reportable segment. So that is a very simple. But a situation like this may arise. Out of 5 segments, 3 are profit-making segments, 2 are loss-making segments. So what is the basis on which you will determine whether that segment has satisfied the 10% threshold limit? That is where problems like this can be slightly, complicated. But it's all very simple, is it not, friends? For persons like us having come to the final level, definitely we have better idea how to approach and solve problems like this. So where some segments are making profit, some segments are making loss, what is the basis on which you will determine the threshold limit of 10%? Very simple. Calculate the profit of all the profit-making segments separately. Calculate the total loss of all loss-making segments separately. Compare. Step 1. Calculate total profit of all profit-making segments. Step 2. Compare. total loss of all loss-making segments. Step 3, compare step 1, step 2. Whichever is higher, that will be the basis. Based on that, in other words, that is a denominator. The numerator will be the actual amount, the absolute amount of the profit or loss without considering the sign. Let that segment make a profit or loss, doesn't matter. What is the quantum? In absolute terms, only shall be taken as a numerator. Then you have to compare. For example, in this problem, C and D are loss making. Ignore the fact that they are loss making. Take only the absolute amount of loss. Forget the sign. Compare that with the higher of the total profit of all profit making segment and the total loss of all loss making segment. If that is minimum 10%, that becomes an operating segment which is reportable. So that is how the standard asks us to determine the reportable segment. So based on this, we are going to do some calculations and present the answer. Now, how to determine the reportable segment? It's given in Ind AS 108 in this manner. If the absolute amount of its reported profit or loss, absolute amount, do not consider the sign. The absolute amount of the reported profit or loss is 10% or more of the greater of combined reported profit of all operating segments that did not report a loss and the combined reported loss of all segments that reported a loss. That's what I told you. Step 1, total profit of all operating segments. Step 2, total loss of all loss-making segment. Find the higher. Compare the absolute amount of profit or loss. Is it 10% or more? It becomes a reportable segment. That is what the standard says. There is no need that you have to reproduce what the standard says. You can present it in the manner in which I told you also. That means you are clear. You are making it clear to the valuer that you are clear. So therefore, friends, what we should do? A, B, E are segments that has not resulted in a loss. Find the total profit made by A, B, B, E only. Add the profit of A, B and E. Similarly, step 2, all segments in loss. Find the total loss. It is 6,800. Step 3 is higher of that, 8,280 crores. This is the basis against which we have to compare whether the absolute amount of the profit or loss of that segment is satisfying the threshold limit of 10%. If it is yes, that is a reportable segment. That's it. 4 or 5 marks only can be given for this problem, friends. Definitely not more than that. So based on the above, you'll determine the reportable segments as follows. So in the form of a tabular column, we have presented like this. Profit or loss of that segment. But you're going to consider only the absolute amount. We are not going to consider the sign. Signs will not be considered. Denominator is 8,280. Numerator is 780. So 780 by 8280. It's approximately 9.42%. That means it is not 10%. So it is not a reportable segment. Whereas 1500 by 8,280 is more than 10%. It is actually 18%. So it's a reportable segment. So let me put a cross for no. And all these will satisfy the threshold limit of 10%. Consider only 2,300, ignore the sign, 28%, 55%, 72%. So segments B, C, D is reported profit or loss is at least 10% of the higher of total profit or total loss of the respective segments. So therefore, other than A, all the other operating segments are reportable segments. So therefore, we conclude B, C, D, and E are reportable segments. I'm sure, friends, there is nothing great you will have to ask in this. But if you do have any questions on this, please feel free to ask me. Let me explain that, and we will take leave from you today if there are no further questions. If you are clear, tell me, sir, we are clear. We don't have any doubts. We can close it for today, friends. Thank you so much for joining for the live session today. And with much more interesting problems like this under various other chapters, we would like to meet you next week.